Hello everyone, I'm CA Neeraj B. Welcome to my YouTube channel Accounting Buddy NB. In our today's YouTube lesson, we begin by understanding the true meaning of accounting, not just as a definition, but as a structured way of recording, summarizing, and analyzing financial activities of a business. We then explore how accounting acts as a business language, helping businesses communicate financial information clearly to all the stakeholders for better decision making. This session further breaks down the core characteristics of accounting, including identifying, measuring, recording, classifying, and summarizing transactions in a systematic manner. Finally, we emphasize the importance of communicating financial information, enabling businesses and stakeholders to understand performance, ensure transparency, and make informed decisions. So sit back, relax, and watch the full video. Before we get into the complex academic definition of accounting, let us understand some basics. Accounting is made up of two elements. First element is bookkeeping. Bookkeeping means recording of business transactions. For any small business like a restaurant, travel agency, hotel, hospital, supermarket in your respective cities, or a big business like airlines, railways, car manufacturing, there will always be business transactions in order to run the respective businesses. Now the question is, what is a business transaction and what are its characteristics? There are three basic conditions which must be fulfilled to classify a transaction into a business transaction. First, two or more parties are involved. Second, there is an exchange of goods or services or money among the parties. And the third one is the transaction is related to business. Now let us understand this further with examples. Purchase of goods from the supplier by the business is an example of business transaction. Other example could be payment of salary to the staff, cash deposited in the bank. Now let us further understand, in case of salary payments, there are two parties which are involved, business and the employees. Salary is paid for the services provided by the staff to the business. There is an exchange of services and money among these two parties. So all the three basic conditions of a business transaction are fulfilled in all these examples. At this stage, it is also important for us to know what is a business and what are the various type of business entities. A business is basically a commercial entity which exists with a view to make profits. At this stage, let us understand that there are three type of business entities: sole trader, partnership, and the company. The examples for each type of business entity is displayed on your screens. We will learn in detail about the business entities in our subsequent lessons. Now, the second element of accounting is the financial statements. Financial statements are a summarized form of all the business transactions. Bookkeeping is the source of making financial transactions. We will learn a little more about financial transactions in our next slides. In nutshell, bookkeeping records business transactions and financial statements summarizes them. Bookkeeping and financial statements together are referred to as accounting. In the previous slide, we learned that a business is a commercial entity formed with the objective of making profit. We also learned accounting is recording of transactions and presenting them in a summary form. With this learning, we will further broaden and strengthen our knowledge about accounting. We will divide our understanding of the accounting into two parts. accounting as a business language, and accounting as a systematic process. Now, in nutshell, accounting is nothing but a systematic process of identifying, measuring, recording, classifying, summarizing, interpreting, and communicating financial information. All these seven pillars of accounting will be discussed in detail in our subsequent slides. Like any other language which is used to communicate, accounting is considered as the business language to communicate business related information to its users. The result of accounting process, that is financial statements, communicates essential information about a business to the stakeholders. At this stage, let us learn few terms which will enhance our understanding of the term accounting. Profit or loss. Profit means when the revenue is more than cost, and the loss means when the revenue is less than cost. Another important term which we must understand at this stage is the accounting period or the reporting period. Accounting period or the reporting period is the time span for which a company reports its financial performance and financial position. It could be monthly, quarterly, half yearly, or yearly. 12 months reporting period is called the financial year or the fiscal year. Another term which is used in the above definition of accounting is the stakeholders. Now, the stakeholders are the individuals or the entities which are interested in the financial statements of the business for one reason or the other. They may include management, public, government agencies, banks and lenders, and investors. Accounting is a systematic process which follows certain rules to record and present financial information. For example, business transactions are recorded date-wise and with proper narration and justification for each transaction. It follows accounting rules to make it meaningful. Therefore, accounting works under a structured framework of methodical recording of business transactions. This systematic approach in accounting is evident when we learn about characteristics of accounting or the seven rules of accounting. First step in systematic approach for accounting is identification of business transactions, which has a financial impact and is backed up by a documentary evidence. Any transaction or event which impacts the financial position of the business is a financial transaction for that business. Let us understand this with examples. Financial transactions can broadly be classified into four types for any business: sales, purchase, receipts, payments. Each type of transaction is explained in brief with corresponding identification documents. Now let us understand the examples of a financial transaction and a financial event. Mr. X, who runs a restaurant, bought two motorcycles for home delivery to increase restaurant sales. Now, buying two motorcycles is a transaction and it is for a business. It is in exchange of money, and the invoice copy is available as the documentary evidence. Therefore, it is a proper identified business transaction. Now, let us talk about the example of an event. Mr. X, who runs a restaurant business, one of the home delivery motorcycles met with an accident and is beyond repair, and it is a total loss. Now the delivery motorcycle is no more available with the business. This event has an impact on the financial statements of the business. Now the business has lesser assets. This event needs to be recorded. Second systematic approach in accounting is to measure the identified financial business transaction into currency of the country in which the business operates. All the financial transactions are measured in the same currency. It also means if the original transaction, say, is in USD, the USD transaction will be converted into INR at USD versus INR exchange rate, assuming the place of business is in India. Let us understand this with an example. Mr. X bought 25 kg of sugar for his restaurant for INR 2500. Such a transaction is identified with the help of the supplier bill with a monetary value of consideration paid or payable. All the business transactions cannot be remembered. Therefore, every business transaction needs to be recorded in a systematic and orderly manner in the book of original entry, which is called the journal. For large businesses, the original entry is divided into subjournals, which are displayed on your screens along with the respective business transaction types they are meant for. In the next slide, we will learn recording of a business transaction with an example. Let us understand recording of a business financial transaction in journal book with below example. Mr. X, who runs a restaurant, bought two motorcycles for home delivery for $5,000 each, and the transaction is settled by cash. If you analyze the above business transaction, the motorcycles, which are the assets of the business, will increase and the cash balance of the business will reduce. This is how a typical journal entry will look like. There will be a journal entry number, the date of the transaction, the respective chart of accounts which needs to be debited and credited together with the narration of the transaction. At this stage, just remember how a business transaction is recorded in a journal book. We will discuss journal entries and related rules in detail in subsequent lessons. For any business, the number and the type of business financial transactions for an accounting period of 12 months will be numerous. Under classification process, transactions recorded in the journal books are posted in the main books of account called the ledger. Therefore, the systematic classification of similar transactions under respective accounts in the ledger is an important process. A specimen of a ledger account is displayed on your screens. A ledger account shows the accumulated total value of the transactions for a reporting period. For example, in the ledger account on your screen, the business has paid total amount of INR 30,000 as office rent for 2 months. Likewise, closing balance of all the ledger accounts is summarized in a document called trial balance. Once the individual transactions are posted from the journal book to ledger, still it is voluminous raw data. Therefore, the classified data, as explained in the previous slide, is presented in a summarized manner for easy understanding. The classified data from the trial balance is used to prepare the under mentioned financial statements. Profit and loss account is a summary of profit or loss for a reporting period. Balance sheet is a summary of assets and liabilities as on date. Cash flow is a summary of opening cash and bank balance, inflows, outflows, and closing cash and bank balance for a reporting period. Profit and loss account, balance sheet, and cash flow collectively are known as financial statements. Once the financial information is available in the form of financial statements, that is profit and loss account, balance sheet and cash flow, then the important part of accounting comes into picture, that is analysis and interpretation of financial information. This is a process by which the financial information is logically simplified so that the users can make meaningful assessment of the business. There are two words, analysis and interpretation. Let us understand their meaning. Analysis means simplification and methodical classification of financial data, and interpretation means explaining how to make sense out of it for decision making. Let us understand this with an example. Now, in financial statements, there is one figure of sales for the year, say 52 lakh Indian rupees or 5.2 million Indian rupees. When we analyze the data, we break it down month-wise and compare it with month-wise data of previous year. The data tabulated and shown on your screen is analysis. Now, example of the word interpretation in relation to this data could be there is an overall growth of 12% in financial year 23 over financial year 2022. Another example of interpretation could be in May 23 and June 23, there is a degrowth as compared to previous year for the same months. Such and more logical interpretation of financial information helps users to take future business decisions. Once the financial statements are made and the analysis and interpretation is done, financial information is communicated to internal and external stakeholders. I hope you remember the meaning of stakeholders we discussed in one of our previous slides. Internal stakeholders are management and departmental heads of the business, while the external stakeholders are banks and government agencies. Timely communication of financial information is extremely important for decision making and for statutory compliance. The communication includes the profit earned or the loss incurred during the accounting period, the value and the nature of assets, liabilities, and the owner's equity. Now, if we summarize, the entire accounting process involves 7 steps as shown on your screen. We have learned each step in detail with example in our previous slides. For super easy understanding, accounting process is shown in the form of a flow chart which is self-explanatory. In my next video on 11th April 2026, the lesson builds a strong foundation by first exploring whether accounting is an art or a science, setting the conceptual base. It then explains the key branches, financial, management, and cost accounting to show how accounting serves different purposes. This session highlights practical differences between financial and management accounting, along with a clear distinction between bookkeeping and accounting. Finally, it brings everything together through the core objectives, functions, and advantages of accounting, reinforced with questions and answers for deeper understanding. If you enjoy the content of my channel and appreciate my teaching style, please subscribe, share and like my YouTube channel @AccountingBuddyNB. Thank you and goodbye for now.